back to part two of the day trading. Today's the charts and pattern. Welcome to part two of the episode. And yesterday, no, actually, well, the day before yesterday, we got into the charts, and I was teaching you how to use the charts with like candlesticks and all that. And I even after that, and a day after that, I went to TradingView and showed you TradingView, and I hope you was on to TradingView and getting used to it, playing around with it. That's what you should do at the start. Just play around with TradingView. Spend as much time as you can with TradingView if you are really dedicated to this, because this is a dedication job, something you have to be really, really dedicated to do. But yeah, I showed you that yesterday. Now today is patterns. I'm gonna show you today. We're gonna learn about patterns and trend lines. Let's get onto it. Now, patterns. Patterns are shapes or setups you see on stock charts that can help traders predict where the price might go next. They're created by connecting key price points or lines like highs and lows, and are a big part of technical analysis. It's just like reading the chart. It's a big part. So you can see all these patterns. Now, I wouldn't use patterns as a strategy, but I will use pattern as an indicator, and as an indicator like where the stock is gonna go. So if I was trading a stock and it went up high, like, and it starts going down like that, oh, I recognize that pattern. So I'm gonna draw the lines, and I'm gonna wait until a breakout, and then boom. I wouldn't, for a strategy, you have to make sure it's really, really good. And if it's really, really good and it works for you, you would probably go like not as heavy, like put a lot of money into it, but some money because you're confident. If it comes to this, and I see this, I will put not as much money, probably like 1/5 or 1/6 of my, or 1/7, 1/8 of my initial bought, if I use my strategy, if you understand what I mean. So, but these patterns, I don't use patterns as a strategy. I just use them as an indicator on where the stock might most likely will go. And sometimes if I see that pattern, yes, I will get into a trade, but not with the same amount I would use as my strategy. If that makes sense, I hope that makes sense. This is going to be useful when it comes to trading, because if you start to grow an eye for trading, you start to see patterns coming in without any lines needed. So you just see it in your head to be created, because you already created them in your mind. See, that's the mind of trading. You can see it's your mind is now a mind of a trader. So this means you see them faster and now able to react faster, so you can buy or sell. Oh, there's an and. Ignore that and though. But yeah, with day trading, you want to be able to react really, really fast. If you miss even a second, that stock might go all the way up and you missed your opportunity. But if you was fast and reacted fast, I buy, boom, right there, I'm in it, and it goes up and I get out, reacting fast again, made money right there in less than 10 seconds. I remember winning a trade and made money on it, winning less than 5 seconds. I don't know what my fastest trade was, but it was either 5 to 10 seconds, and it was really good. So yeah, you want to be able to react, and I got that by enabling to react fast. Let's get on to the next. Trend lines. Now is the trend lines. You just saw patterns to see trend lines. There's ranging, up and down, uptrend and downtrend. Yeah, three different kinds. Trend lines are very important because the stock market respects trends like a lot. What this means is if you see a trend line, it tends to follow it. So let's see. This is an uptrend. Trend lines, are also lines that are showing you where supply and demand imbalances are. So once it goes down here, there's a lot of demand and people will buy. So boom, 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 it goes down. A lot of demand. Boom, boom, goes up. It goes down a little bit. Boom, 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 and forming a trend line. These are the key points when to form that trend line. You need I recommend three connecting points to make a trend line. Then we have downtrend. Ignore this line right here, but this is a downtrend, so it goes up. Then we have supply. There's a lot of supply, so it boom, boom, sells, boom, 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 sells, boom, 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 sells. See right there, it formed a downtrend. There's 5 things we need to know what the market is doing. There's 5 things. If there's a trend in the market, if the market is ranging, breaking out, pulling back, or is about to reverse. And trend lines can help with all of these, because trend lines form all of these. They form ranging, breaking out, pulling back, and about to reverse. There's 2 types of market though. There's a trending market, up and down market, or a ranging market. Let's get on to the trending market first. Trending market is when the price is clearly moving in a definite direction. So you can see this is obviously moving in an uptrend, and this is obviously moving. This is obviously moving on a downtrend. But why is it uptrend? Because of how the price is structured. So this is a high, and it just formed a higher high. Then it formed another higher high. Then it formed another higher high, and another higher high. And then this is a lower low. Then it formed a higher low, another higher low, and another higher low. If this was going down, let's use this one right here. This was a high low, lower high, lower high, lower low, lower low, lower low at these points. These points are lower highs. So they're up high, touching the point, but they're lower than the previous high. A bit complicated, but I think you can get used to it, and I hope that makes sense. Because the high and lows of the price is consistently getting higher and higher, once identify a ranging market, next is to draw the key levels. So uptrend and then ranging market. So it's not a line going down or up, it's just a line going straight. See, it's just consolidating. It's just not going up or down as much. It's still going up and down, but just keeping it in a range, like keeping it in a box. And if you see that on the chart, that's one of the tools you're actually gonna use as a box or a rectangle, to be more precise. But yeah. And now we have ranging markets. Now you see when it's ranging, you might be asking what is a ranging market? Where the price moves erratically without having a definite direction. See, up, down, up, down, up, down, up, down. Will it continue going more up, or will it continue going more down? Nope, it's just going up, down, like little by little, staying. So let's say this is $9 and $10. No, $9.50 and $10. It's just staying at that level. Now, of course, when it goes down, you can buy, but it's not as much, and that's still very dangerous because it still can crash down. Traders tend to avoid this type of market because it's a lot harder to predict where the price will go next. They tend to avoid this also because most indicators tend to not work properly on them. Yeah, but if you have an IVA trader, I'm pretty sure you can get around that. But still, indicators still work, but not as much as as an uptrend market or a downtrend market. Unfortunately, ranging markets are unavoidable. So you will encounter them, sooner or later. Now we have ranging markets. Let's get more into the ranging markets. Markets only trend 30% of the time, while on a range market, on a range 70% of the time. They range 70% of the time, but other times they tend to trend up or down 30% of the time. Meaning markets are mostly ranging. Well, why not take advantage of them? We can still take advantage of it. Best range market strategy. Not a strategy per se, but like a helpful tool you can use. You can use to still buy and stuff. Easy to identify them. How do I identify them though? Easy to identify them after they are already formed. If they're still in the process of forming, it tends to be harder to spot. A way to spot them is to pay attention to the market structure. So you got to see how the market is really going. Let's take this for example right here. If it's going up, obvious uptrend. Key points is right here, right here, right here, and here. You can form a line connecting those points, those higher lows. So that's what you want to use, and you want to draw a line, and that's going to be helpful. Now, let's say that line continued, it broke that line, and it's going like this. It's ranging. It's keeping itself between 2 points. It's not forming higher highs or lower lows. Keep in mind, it's very rare to find ranging markets that move perfectly between the key levels, but it's okay because it's a general area. So it keeps it in the general area of a box. It does go out some moments because it's not gonna be perfect, obviously, but it will go up somewhat, and you can once you get used to it, and this is why I recommend going to TradingView. Once you get used to it, then that's where you can identify it and spot it. Once you identified your key levels, next is finding your entry signal. You want to take advantage of the price bouncing off those key levels. Keep an eye on new key levels that may form. Another type of ranging market that you may encounter is called a narrow ranging market, when the distance between the upper and lower levels are too narrow, like they're really squished. It's where we have a big rectangle, but then we squish it down, or where the length is really not that much, like the distance between the top and bottom of that rectangle is not that much, so it's really ranging and not moving as much. I try to avoid. That's why I go into markets where there's a lot of people, because if there's a lot of people, it's gonna bounce all the way up or bounce all the way down. But I'm hoping to catch a stock that bounces all the way up. A small strategy for a ranging market is what I'm going to teach you right now. There isn't much room for the price to move around, meaning you won't be able to trade it using the key level bound strategy. How do I take advantage of this type of ranging market? Use a breakout strategy, like I said before, because if the markets are moving on a narrow range, it indicates that the price is consolidating. Usually, after the price consolidates, a breakout tends to happen. That's when you want to find a breakout. Enter before the breakout happens and make a profit. So once it escapes outside the box, once it clearly escapes outside the box, that is your opportunity, because it usually means pretend the stock is in chains in that box. Once it breaks out, boom, breaks the chains, I'm all free, and it jumps, and that's what usually happens. Or if it breaks down, it's still boom all the way down, but you can remember, you can still make money on the market going down. Find a narrow ranging market which can be identified by multiple small candles moving sideways erratically. Tip: you can find them a lot easier on lower time frames, such as 1 minute to 15 minute time frames. Number 2, draw the key levels. Don't draw them too closely. Give enough space for the price to move in between so we can avoid false breakouts. Number 3, figure out the breakout direction. Will it happen to the upside or will it happen to the downside? Like I said before, keep in mind false breakouts happen very often. So those 3 tips I really recommend you use. And remember, if you want to do a breakout, you got to pay attention to the candles of a breakout too. And I'm going to get into that soon. But like I said, keep in mind false breakouts do happen. But the question is, how do I avoid those false breakouts now? And here is a very useful tip on how to avoid false breakouts. A way to avoid them is by waiting for a momentum candle to break out of the key level. So remember that key level or that line we drew? Now we look at the candles and we analyze the candles and wait for the candles to break out of that key level. And we look for a momentum candle. A momentum candle can be in the form of a big candle, which we have right here. Imagine this candle but longer in a big candle, because candles usually form like this, like that. But we want a candle that breaks out of it that's really big. Or multiple medium-sized candles. So we have those medium-sized candles, those normal-looking candles. We want to have multiple of them breaking out of the thingy. So try to keep it in a row. So if you see a red candle, try to be very wary of that. A too small candle, it's hard to spot, but over here, a small candle, too small to be classified as a momentum, it's probably gonna be a false breakout. So be very wary and yeah, don't try to fall for it. Meaning you don't want to take any position yet because this may be a false breakout, like I said exactly. See, this is the key levels I'm talking about. The lines. We're waiting for a big, like that. You see a big green candle, which means we now have momentum candles. Based on this, we can conclude that the breakout will likely happen to the upside or upside. Good opportunity to take a buy position. And if it's going down, let's look at right here. If it was going down and made a big red candle or a lot of medium-sized candles in a row, that's an indication that it's going to go to the downside and we take a sell position where we bet on the market going down. But yeah, like I said, there's actually, from the start, let's go back, we got to the ranging, we got to the breaking out. Now we have to go to pulling back and to reverse. But I'm going to teach you it tomorrow. And just for now, so you don't feel overstimulated, just for now, try to get used to a ranging, try to identify ranging markets, and try to see when they're going to break out. Don't fall for that false breakout, and try to get used to it. The key is building experience. If you build that experience, you grow your knowledge. The more knowledge, the more power, the more better. So yeah, so try to get into the ranging and the breaking out. And the next video, we're going to do pulling back and reverse. But thank you so much for watching for today's video. If you like it, leave a comment, subscribe, and ring the bell, because I will be posting that video on pullback and breakout. No, sorry, pullback and reverse tomorrow. Thank you for watching, and I'll see you tomorrow. Bye.